Hey everyone, Tom Gentile here, America's pattern trader. And today I want to show you how to create a call spread using the options platform in Hubb. So just to the right of me, I have the Hubb platform on, and I want to show you how we take this to an option trade. So this is a chart of Apple. And let's say I wanted to create a call spread on Apple because, again, a call spread is going to be cheaper than a call, gives me the rights, and it does give me obligations, but I'm able to put a spread on buying a lower strike, selling a higher strike for lower cost, lower risk, and better break even. This is how it's done. Down in the bottom left-hand corner of the chart, you see the options tab. Click on it. That will open up the option chains for whatever you have up here in the underlying. Now, you're going to see the nearest dated options open first. Calls are on the left, puts are on the right. I want to stick with the calls, and let's say I want to go out a couple of months. So maybe my, I want to go out to for the May options. These are a couple of months to expiration, and I'm looking at, again, the shaded area tells me that that's where the near money options are. So as I'm looking at Apple, and I'm looking at once again the price of Apple. And the price of Apple right now is at $257.34. So maybe I want to buy the 250 calls, all right? And maybe I want to sell the 260s. It looks like this. You'll see across here, you'll see all these different columns. You'll see a bid and an ask. Move your mouse just down to the strike price you want and click on ask. That will emulate buying a call option. And then in order to sell, to complete the call spread, you're going to drop down and you're going to find a strike that you want to sell. You're going to move your mouse over to the bid section and click on that. And that's going to put in the -1. So now we're long a lower strike and we're short a higher strike. What's this going to cost me? What's my details? Well, you'll see those to the right. And to the right of the option strikes, you'll see the details. And here we are, buying to open. There's your 250 call, selling to open the 260 call. Both for May expirations. This net debit here is what you're paying for the spread. That is mid-price. Okay, so we're setting this up as a mid-price trade. What's my risk? What's my reward? What's my break even? All of those details are shown right here. Max risk, maximum profit, and your break even on this trade as well. And then finally, what you can do is you can see all this visualized in a risk graph. So just above the details, you'll see something called risk curve. Click on risk curve. That's going to open up the risk curve for this particular trade. As you can see, as I squeeze this in and I look at this, it's going to show me exactly what this risk curve is going to look like from one end of the curve to the other. So I can see that my maximum risk is below 250. My maximum reward is going to be above 260. And of course, all of these lines inside here are days to expiration and really theoreticals in terms of where those options should be priced should the stock be at one point or the other or anywhere on this particular curve. So there you go. That's how to put in a call spread using the Hubb options platform. Thanks for joining me. I'll see you on the next one.